Macroeconomics number 6. This session will discuss money, what it means, what it is, how do we deal with it, and then of course what happens with a checkable deposit system and how our deposit system for banks helps us create money. This all leads to the money multiplier, which may or may not be covered in this one. We'll have to see how far we go. First thing is money. Students for the AP have to know and remember that there's 3 basic definitions for what money is and be able to differentiate between those. So money is, or the money functions. Money functions, number 1, as a store of value. Number 2, as a unit of account. And number 3, as a medium of exchange. These are vital functions for money, and these are the characteristics of money that make it so valuable for facilitating transactions in our societies. First, store of value. It enables us to hold value over time rather than having something depreciate. So if we have the value of money is that money should not lose its value over time. If it's bills, currency, something on account, it doesn't matter whether it's this season or next season or a year from now, a coin should still be able to be spent. Whereas if we were trading in grain, grain might be subject to mold or some other infestation of animals that would decrease its value. So it's a store of value, we'll hold it over time. Number 2, a unit of account. We know what it means, that $10 should be something that has meaning irrespective of the transaction or the persons involved in the transaction. So it's not a case of personally valuing a commodity and having to barter it against something else and always coming up with a different exchange rate for barter, but rather that things have a value or are denominated by values of dollars, and those dollars are independent of the transactions. They mean something to all the people in society. It permits it to be traded between and amongst all these people. And the third is medium of exchange, that we can use money instead of the items themselves, the barter items. And so it facilitates exchanges across wide distances. People in California can trade with people on the eastern coast or from other nations as long as they accept the currency. And it permits us to have a wide variety of exchanges that again transcend the limitations that we have with barter. So store of value, unit of account, medium of exchange. I don't think these will be essay questions, but they might be out there as multiple choice questions, important to know. Have to be memorized. All this has to be memorized. So that's money. The second thing about money that we want to consider, these are all introductory topics, is the nature of the liquidity of money. How do we define money or the money supply? Money supply is designated with an M and a number. We have M1 or M2. M3 is no longer tracked and used. Some of the older textbooks may describe it. I believe the AP has forsaken it, so here it goes. M1, M2, the difference is liquidity. So this is, excuse me, sorry. I meant to say it was less liquid. Liquidity is a term that we use to describe how easily money can be used in a transaction, or something can be used in a transaction. Is it something that can be used instantaneously, or does it require some type of transformation that will take some amount of time? So in this case, M1 is a simple thing, things that we can use: coins, cash, or checks, or which would be demand deposits. We call these demand deposits. Because individuals can demand their money from the banking institution at any time. At least that's the concept in theory. So this is very liquid. Coins, and currency, and a check, any of us can go out at any time, immediately go to a store and use one of those items, coin, cash, checks, for a purchase. There's no intermediate type of transaction necessary. We don't have to wait. It's available instantaneously to be used for purchases. M2 includes all the above, plus what else? Well, what do we have out there? Savings account, and time deposits. These are accounts with banks. These are accounts with banks that have some type of limitation on them in regard to the access to the funds, how quickly and easily can get to the funds, or the frequency with which the funds may be withdrawn and used. For example, savings accounts or even some money market accounts frequently have a limitation of 3 or 5 transactions per month or per period. And above that, there's a penalty that the banking institution charges the depositor to discourage the frequent use of these funds. So these funds can be used sometimes, but not as easily as a check. There's no penalty for writing a check on your account. It's understood that people will do that for a demand account. For a savings account, only a few times in a period that an individual can use it without a penalty. Time deposit is even more restrictive. Time deposit is something like a CD or a certificate of deposit. Certificate of deposit has a time limitation, or time during which those funds are not available at all. So a certificate of deposit sometimes might be designated for 12 months or 18 months, during which those funds are not available at all. If an individual who put those funds on deposit in a certificate of deposit would wish to use those funds, they can be used maybe, but at a significant penalty. So there's some interest as these funds are less liquid, banks will pay a higher interest rate or compensation to the lender because the lender is foregoing access, and the bank has these funds then for a longer and more secure period of time during which the bank can do what it does, which is lends money out at some sort of interest rate and looks to make a profit between the spread of the interest rate that it charges to borrowers and the amount that it pays to the lenders, who we are. So there we have it. We have going down here less liquid, or alternatively you can look at these as more liquid. These things we can use right away. These things have limitations and don't have the same easy access. We care about these differentiations because certainly before we had credit cards and instantaneous online transactions, electronic fund transactions, these differentiations helped the Federal Reserve, the banking system, estimate the amount of transactions that the money supply would sustain and support. Given a certain amount of money, we are going to talk about this again when we get to the multiplier, a certain amount of money permits a certain fixed amount of transactions in the economy because people need money at some point to pay for things. Here, these funds are less accessible, less liquid. They're going to be more restrictive in terms of the inability or the decreased, the smaller amount of ability to support transactions. With the advent of credit cards and more plastic electronic funds transactions, all of this is less relevant, and that's one of the reasons that M3 has gone away. They matter a lot less because we don't really use cash or these near cash equivalents the way we used to support transactions. That's the description of money and what money is. I will, in number 7, start to talk about the checkable deposit system and how we get to the expansion of that system.